Good morning, good afternoon, everybody. Warm welcome to everybody out here today. Crazy market day. Very, very interesting. We had a great time in the Traders Lounge this morning. Matt, how you doing this morning?
No, I'm doing absolutely fantastic. I about said, Tim, I'm doing absolutely great today. Like I've done,
Hey,
I've done so many shows with Tim over the years, that it's just
So
like
many
Tim.
habits.
So it's like every time, Tim, I'm doing absolutely fantastic, and Mark will come in and be like, I hate all of you guys for even saying hello to each other. But no, I am doing great today. Excited to be here with Coach Noah and Coach Gino for the halftime report, and an important day in the market, no doubt about that, Noah.
oh yeah, interesting day. We've got you got your screen up yet?
I should, yeah.
Should, yeah.
Yeah,
Oh,
I'm
it's
looking
right
at
there. It's right there. I thought I was looking at my computer screen for a minute. Man, woo. All right. It all looks the same, right? Red. So that's a pretty big, interesting bearish engulfing. What do you want to say about the whipsaw on the market? I mean, it's been interesting with that big rally yesterday. Bounce back down off of those moving averages. Some negative news coming out, and the market giving up all that ground covered yesterday. I'm sure that's leaving a lot of the swing traders in a lurch, and the day traders are probably laughing all the way to the bank. Meanwhile, your theta traders are watching like a hawk, just making sure that everything
Mhm.
stays neutral in the middle there. Um,
Well, I mean, just to kind of get everybody up to speed on kind of what was the news that kind of transpired here today, there's a couple things going on. Number one, the snapback rally in the market yesterday was certainly some whipsaw. I think all of us who had bearish triggers coming into to Friday and coming into Monday, I mean, we got a little whipsaw, and I got stopped out on a couple of the positions, but a lot of those bearish positions, they just kind of got whipsawed. But the market never broke its resistance level, and a lot of those bearish trades didn't break their resistance levels either. And so, from a technical perspective, when we were looking at this yesterday, when I was talking about the market at 29.40, 29.45, if it did break above that level and close, you could see some run. But that was a fairly important intraday level of resistance. And then on the overnight action, breaking this down from an intraday perspective for the crew, on the overnight action, as the European markets start opening up right here, Noah, you started seeing a lot of capitulation coming into that European. And what really kind of transpired was, on the overnight action, was Germany released an economic report, and they showed German exporting data that is in recessionary territory. And I think that's the word of the day. Can we all agree with that? That's the word of the day, is recession, recession, recession. It's all over the place. Germany came in at recessionary territory, and once that German economic report came out, you really started seeing the market just kind of sell off. Because if the eurozone goes, and think about this, guys, if the eurozone goes into a recession, can't we almost guarantee that the U.S. goes into a recession?
Oh yeah.
Since like 30% of all S&P 500 revenue comes from the eurozone. And so if the eurozone is screaming recessionary territory, and that's when you saw that 29.20 level broken right here. And once that 29.20 level was broken, it was just off to the races. Cash open was really kind of what I was looking at here today. Cash open happens, and it was just a bloodbath after the cash open as well. And that's when the news really started coming out right here, that the yield curve, the 10 and the 2 yield curve, had inverted for the first time since 2007. And I want to get your guys' take on this, because I do feel it's important. And before we talk about it, let me just give you a couple data points. In the 5 recessions we've had since 1980, 5 recessions. And by the way, guys, if you understand we've had 5 recessions since 1980 and 13 recessions since 1929, you understand that recessions are a normal part of the market cycle. But in the 5 recessions since 1980, each recession was preceded by the 10 and the 2-year note inverting, and about half of those times it would happen within the next 3 months. What's your guys' take on the invert? First of all, Noah, can you kind of just explain what the yield curve is, the 10 and the 2 yield curve, and why it's important? You're on mute, bro.
Well, I didn't even get a chance to drop any wisdom with my mute button on. But the yield curve is just a really interesting metric to follow, because really, in my mind, this is kind of how I've always looked at it, is, again, it's the risk of lending money and the return on lending money. So when you look at longer term interest rates and you have lower rates, and we've been in a rate cutting environment again, and those longer term rates are down. And when people get a little nervous, I think those short term rates, again, the risk spikes up. So in my mind, it speaks to it creates some liquidity in the lending markets, problems with liquidity in the lending markets. People would rather be in short term than long term because the yields are higher. Mm-hmm. And so, when you see that longer term, rate up above the shorter term rates, everything's great. People will buy the long term stuff. But the minute that inverts over, all of a sudden, I think you run into fear of lending, concerns about liquidity in the bonds, and then people may want to dump those bonds. But it is definitely a recessionary pressure when you look at it. And I don't think I understood it when the first time I really endured a bear market. Like I started to learn how to trade during the .com crash. And, my first really, active bear market in 2007 and 8, I didn't understand the yield curve at all. I didn't see that sign coming. And so, this time seeing it coming, I've been a little bit on high alert and very, very suspicious of all the bullish activity on this market for some time now, just because it's not hard to see that a recession is coming. But like you tweeted out this morning, Matt, it's timing. When does that yield curve invert? When do you see those recessionary numbers kick in?
Well, it's the analogy I gave, it's man-to-man versus zone defense, right? We know we're in the zone of recession. We've known that for quite some time. We know it because of what's happening with growth in S&P 500 company revenues. We know it because of slowing growth from a GDP perspective from around the world. And we know it, number one, I mean, you don't listen to what the Fed says, because the Fed comes out and says there's no recession, there's no recession, there's no recession. Bernanke was saying there's no recession in 08. We were already in a recession. I mean, that's what the Fed states. But it's always based on the actions. When the Fed starts lowering rates, it's because they see this recessionary data, but they don't want to come out openly and say, yeah, we're staring smack dab at a recession. Because if Jay Powell came out in his speech and said, we're staring at a recession, the inverted yield curve is very, very concerning. Chinese industrial production is showing recessionary data. European economic data is showing recessionary data. And we're seeing recessionary data in the US. If he said that, what would everybody in the world do? They would sell US stocks.
Yeah, and it creates a panic. So then nobody's going to really, give you that. I think it's one of those things like yelling fire, but in a public theater.
Yeah,
you can't do that, obviously, but you want to be the first one out the door. So, you can't really tell everybody, hey, we got a recession coming. It's like you quietly start selling in advance.
For some reason, I just started thinking of Inglourious Bastards.
That's exactly what came to my mind too.
I just started thinking like the awesome Brad Pitt movie, but Quentin Tarantino. So if you've never watched that movie, go ahead and watch that movie. It's awesome.
An entire generation of people believe Hitler was killed in a movie theater, right?
Oh Lord, that's so sad.
Oh my God,
that's so sad. Probably true. Probably true, but the reality is we are seeing that, and we're in that zone. Timing is always based on technical analysis, and really when you're talking recessions, it's based on weekly charts, not daily charts, and certainly not an intraday chart. But that's what the market is really kind of showing here today, is for the first time that curve inverts, and you're seeing a lot of downward movement in price and a lot of bear trades happening here today. Gino, what's your take on the inverted yield?
Well, what's amazing is it's been signaling that off and on flattening yield for the last couple months. When it inverts, that means the short-term rates are higher than the long-term. I was looking at when the news came out, Matt, I was looking at that. And I can't remember what site I was looking at, but it was the United States, Bloomberg. Bloomberg lists all the bond yields. In fact, I'll put the link in there here in a second.
Yeah, I got the numbers here. The 2 years at 1.634. The 10 is at 1.623. And so, right. I mean, we're just talking a couple basis points, but those basis points are very, very important when you're talking about the bond market.
Yeah. So, it's a flight to safety. And last week's newsletter, I don't know if you out there watch our newsletter. If you haven't, it was golden. I was talking about how these signals in the market, we're stuck below the major moving averages. Do we go bullish? Do we go bearish? I spent hours on end the last week with other trading coaches at Tackle Trading, pros that trade every day. And we analyzed that chart up, down, and sideways. And we ended up saying, you know what? Let's favor the bearish side. Let's go a little bit negative until it gets over those moving averages. Because it's news-driven market, right?
Yeah.
And And we kept looking at it. And then yesterday, Tyler and I on the coaches show, we're looking at that going, you know what? We got triggered to the downside on the S&P. So it's a little bit different chart pattern than ES, because ES shows you 24 hours. The S&P actually triggered to the downside on Monday. And then you see that trigger on Monday? Look at that trigger. Yep. It triggers to the downside on Monday.
Great
so
trigger.
The newsletter, I said, if it triggers below Thursday and Friday's low, that we're back to bearish. Then what happens yesterday? We rally on some news that's good for the US. Big old green candle, big old golfing candle yesterday. And it goes above the swing high pivot, which means a lot of people probably got stopped out of their bearish trade right after they got triggered in. Mm-hmm. Then I'm going, okay, but we didn't make it above the moving average yet. So that's why you put your stops a little higher than you need to. So a lot of people got stopped out. I talked to a lot of students, a lot of traders. They're like, oh boy, shakeout time. Are we going to follow through today? Well, here's your answer. I wake up, boom, back to bearish territory. And this time it wasn't unsurprising news. It was trader news. It was the bond market coming in and saying, you know what? So what triggered all this, Matt? If you look at the newsletter, I said, you know, guys, we could go bullish next week, but I don't see it with the rest of the world being bearish. I just don't see it. It's really hard for America to go bullish when the rest of the world is bearish. So I want to look at three real quickly. FXI, there's China. Really hard for us to go bullish when you got a trend like that.
Well, and let's talk about this level of support here on FXI as well. Mm-hmm. That support at $38 has been a very, very strong level of support for years now, not days. And you're currently ticking at 36.84. I wouldn't call that confirmation yet. I mean, we still got 2 trading days left in the week. But if we do close under that on the weekly chart, I mean, talk about those stop losses that are placed right underneath that level, guys.
Yeah. So, I mean, that, I don't know if you go back in time, Noah, how many years back, where's the next support?
If you break this support right here, that next support is not really until 34.
And that doesn't sound like far, but how many points is that? That's
that's 4 points against the 40. That's another 10%. That's another 10% movement to the downside. But from the tip at 54 to 34, you're also talking about, you know, a 20-point movement. That's a 40-point downward movement in price.
Yeah. So, I mean, now that's the major one you got to be looking at, because this is the major country we're talking about with tariffs. But check this out. Check about the emerging markets, the ones that are based on trade, EEM. There you go. Look at this one. Same thing. That is a classic bear setup there. Classic bear and a reverse cup and handle. So when the rest of the world's doing this, on one more, maybe 2 more. VEU. This is the biggest companies in the world. The biggest companies in the world are international, right? But they're not American. These aren't American companies. Look at that one.
Guys, that's textbook M formation breakdown.
Now look at the daily chart on that.
Yeah, that's textbook M formation breakdown on the Vanguard VEU.
Look at that.
And that's confirmation.
So far away from testing any moving average.
Well, and let's not mince words here. This has the biggest companies in the world in it. This is what this ETF tracks. The top 100 companies that are not American.
So that means they're international. That means they're big in trade. They're big in the currency fluctuations. And they're big on giving you an indicator of whatever country they're in, their economy. So that's the world economy, the global market right there without the US. So if US wasn't part of the markets, that's really the trend. And that one, you don't need any indicators to look at. You can look at that for the last 2 or 3 weeks and go bearish. So again, it's really hard for America to go bullish when the rest of, why? Because a lot of our business and money in our markets comes from overseas. It's a global market. If those companies are not doing good, they're not going to buy from us and do business from us. And the tariff has a lot to do with that, and so on and so forth. And that's what happens. So when you look at the bond market, just because it's a US bond market doesn't mean it's not international. A lot of people for safe haven will go to the metals and they'll go to the bonds. By the way, bonds is 5 times bigger than
and by the way, when we say people, we mean massive institutions, old money, and central banks is really kind of what we're talking about there. And so in terms of that, that's a massive, massive market.
I'm going to look for some strength here. How about EFA? That's another global ticker. EFA. Nope. Very bad. So you see, go back to the tackle trading, you guys out there. If you're not members, having that feel and how I went in depth and said, guys, I just do not see us going bullish. Even if we turn bullish, it's not going to be a strong bullish rally with the rest of the world being bearish.
Well, and that's kind of where I see it here. From let's move it outside just the swing trading and day trading type thing. We all invest as well. I mean, is this a time, in your opinion, from an economic perspective? Well, let me put it like this: do you guys agree that there is more short-term risk than upside gain here?
Oh yeah.
For long term. As a trader, we're going to trade the downside here. I mean, okay. So if there's more short-term risk to the downside than there is upside potential, because I mean, I think we're capped on the upside this year, guys. I don't see us reclaiming all-time highs. Do you?
Barring rate cuts. I mean, if you get Feds coming out cutting rates, is that
I don't think rate cuts will do it.
No,
I don't.
Yep.
I don't think
rate cuts may actually add more fear.
Rate cuts will push the inverted yield curve further.
Yeah.
Okay.
Yeah.
The only thing the Fed can do to stop this, and I've said this before, the Fed can delay recessions, they can delay bear markets, but they can't stop them. The only way to stop them is for them to lose their bloody mind and start quantitative easing infinity. That is the only way that the Fed can stop it, and I don't see them doing that this year. So if we're capped on the upside potential for the rest of the year, with all this recessionary data that we've been seeing in around the world, and including in S&P 500 revenues over the last couple of quarters have been slowing down as well, is it important for those long-term investors to add protection to the portfolio?
Oh, definitely. I mean, you should always have protection in your portfolio.
Okay, and for those of you who are watching, if you don't understand what we're talking about from adding, insurance to the portfolio, well, get into that bear market's, survival system that we have over there at Tackle Trading, and you'll learn every single capacity and strategy that we utilize to protect retirement accounts as markets do go down. Because as a trader, we always got to make decisions based on what we see at the time. Nobody knows what the future does hold, but given the fact that we're seeing price action become this volatile, that usually doesn't happen in raging bull markets, guys.
No,
right?
That's right.
Okay. So if we're seeing, and if we're starting to get into that bearish type territory, and projections at this point have to be down. I mean, even from the time we've been talking, the S&P's lost another 10 points. I think it's important to add that protection, and then let's go trade it, right? Because these can be wonderful, wonderful trading environments.
And by the way, Matt, last week I did 2 shows on the lounge. First thing in the morning with a cup of Joe and Gino, we have, I decided, you know what, guys, if you weren't prepared for the first drop, and Noah said it too many times all through the live shows, be careful that second shoe dropping. That we call it wave 3 or the second.
Yeah, wave 3.
Yeah, wave 3 on Elliott wave, but the second meaning
ABC or wave 3, but this could turn into a wave 3 if they don't, if the fear grips the market.
Right.
Well, and what's but Noah, speak to the difference between ABC versus wave 3, because ABC, you're looking to be a buyer at the end of ABC, and wave 3, you're shorting. So that's an important difference.
Well, you've all heard about the kiss goodbye pattern, right? You've all seen it. Like, you see slowing momentum tops, head and shoulders, M for murders, and you get that breakdown, that first leg down. That's the first sign of a change in direction and trend. And most of the time in an uptrend, it'll turn into a 2-leg drop. Zoom back out, Matt. You got a perfect example of an ABC.
It's right here.
May. Yeah. There's ABC. Yep.
ABC,
go back.
boom.
Yep. It's a down, up, down action. Now, when the market goes into bear market territory, that kiss goodbye doesn't just do an ABC drop. It turns into the third wave. And in the Elliott wave theory, the third wave is the big one. And it's where the meat of the trend really, really takes over. And you'll see drops that go down like 161.8% of that first leg down. So, 100% drop would put you down at 2,700.
See, this is what I love when it's me and Noah and Gino instead of me and Tim. I get to talk all the fancy, Elliott wave and Fibonacci and, all of that jazz. And then we get to go into the analysis of wave 3s, hundreds versus 161 increasing momentum. We geek out. We just geek out. Yeah.
Well, I mean, and it's something. It's a pattern that is a general tendency, and of course, it doesn't always hold true. The Elliott wave pattern is very susceptible to news, and of course, the pattern can be altered by things like Fed interjecting themselves.
Can't any pattern be interrupted by random variables in news?
Yeah, but
right?
But the Elliott wave pattern, in my mind, what it really speaks to is human psychology. Like the first dip, people buy the dip. That second dip, there's going to be fewer people willing to buy the second dip. And if it's a traditional ABC pattern, it'll dip down and you'll see a slowing momentum. You'll see it drop once, and then the second drop smaller. If you look back at May again, it's a good example.
Yeah.
The first drop, and then the second drop, even though it's a good sized drop, it took out the low and it only went about half as much, because it drops about the same amount. But this case, if you get, and this one's steeper. First of all, the first leg down is steeper.
Mm-hmm.
And if you see, again, a steep action and it starts to take out that 2,800 level, I think it's going to start clearing stops, pain thresholds, and fear and greed will grip the market.
Yeah, and let me speak to that real quick here, Noah, because there are some subtle but very important differences in an ABC cycle too. Because when you're just dealing with this typical ABC cycle, like you're dealing with in the April and May drop in the market, that was not a volatile movement to the downside. That was a systematic 1% down, 0.5% down, 0.5% down, a little bit of up, 0.5% down, 1% down. It wasn't a volatile response to the market. This is a volatile response to the market.
Yes, this is a volatile response, a lot steeper sell-off, more volume. Look at the volume. I mean, you got probably a third as much volume extra compared to the previous drop. And it's just, it's heavy selling. Again, and I was a little doubtful that we were going to get that second leg drop after yesterday's rally. But like Gino said, it never took out the 50. It didn't clear the resistance zone. And when it took out today's support, I had alerts set at every support level just to help me keep my eye on that, and resistance level as well. Just because when you do see that third wave, if you can catch a third wave, that you can do pretty well on the trade. It's either a kiss goodbye or a kiss hello. And, you start legging into positions here. And again, I'm not sure if we're going to get a third wave yet, but with all the recessionary data and what you're seeing in the global marketplace, and then the news out of China and Germany, I would not be surprised to see, again, when I say fear and greed grip the market, bulls will start to panic and start exiting, but the bears will smell that fear. And all the people who don't take action, well, the bears are going to borrow their shares and sell it into the market anyway.
Right.
So, the buy and hold crowd still is going to get their assets handed to them.
Because traders like us are going to borrow their stocks and we're going to sell it anyways. They don't know it, but we're going to sell it anyways.
Yes. So, and the bears create liquidity and they're the first ones to buy in at the bottom. So, you can't go get mad at the bears for following their nature and feeding into the fear. But, I know a lot of people would like to eliminate the speculators and, throw heavy taxes on the speculators and whatnot.
Yes. Markets shouldn't do nothing but go up and up and up, and everybody should be rich. And they don't understand how poor that would make them. But most people
if you didn't have contrarians
against their own policies.
Yeah. If you didn't have contrarians and bears, the market prices would go straight up. They keep prices down. And then they create the buying opportunities. And again, it's money doesn't disappear. It just changes hands. And you just have to, make sure that you're on the right side of the trend. So a day like today, good signal. It'll be interesting to see how it finishes up. I'm watching that 2,800 level is the big key level now. It took out 2,850 while we were sitting here. So
yeah. It's like I want to go just trade.
Yeah.
But
well, it's interesting.
I will tell you that's why I do like trading the European Open though, Noah, is not only from a currency perspective, because that's a bank open that I like trading, is the European Frankfurt Open.
Oh yeah. I stayed up late last night just to trade that open and watch the futures. Like I was up.
Yeah. And it allows me to watch the futures. And when the futures broke 29.20 last night, this is when I was kind of going to bed. I was like, oh man, it's going to get ugly tomorrow for a lot of traders.
Yeah. Well, it's interesting, Matt. I'll put it back in the links here. But when I saw the news on the overnight treasury, this has been popping up, the flat yielding, the flat. Now it's inverted. So I wanted to see how inverted it was. So I went in there and I looked at the bond yields. And let me find if I can find the link here. What's amazing is they're talking about the 2 and the 10 being inverted. But actually the 3-month is at 1.92 and the 6-month is at 1.86. 1.96 is a 3-month. that's much higher than the 5-year and the 10-year. So, I mean, it's like the 3-month. So basically your money's more liquid and a better yield on the short term. So
Well, and
it's like, if I'm shooting for yield, I'm going for the 3 or 6 month, not even the 2.
well, and let's be honest here, guys. When you have yields in the short term exceed yields in the long term, that's an understanding of risk on type environment or a risk off type environment. And traders, investors, institutions, they will go take a 1.8% yield, even though it's lower than the level of inflation, because they're not going to get their asses handed to them in the stock market.
Right. And but what's also interesting is the UK and Germany have the 2 and 5 and the 2 and 10 inverted. And that's been, the rest of the world's way ahead of us. That's why you got to look at the global markets, is they've been having the bond problems before us, you know. And another thing is, like Noah said, the first dip they buy, the second dip, they start to question, you know, okay, do I buy again? A lot of money managers, they have to buy. They can only go long. So they have to cost average on the way down. And they got the money to do it. But that doesn't mean they have to buy the stock market. That's where they buy the bonds. That's where they buy gold. That's where they buy everything else.
Well,
So
and that's what I always say. Big money, institutional money, old money. It drives me nuts when I hear this. Oh, money's in cash. Money doesn't go into cash.
No,
money rotates. It rotates from aggressive to defensive sectors. It rotates from aggressive type investment opportunities to safe haven assets. And whether you agree or disagree with the 1.69% bond being a safe haven asset, it's still considered a safe haven asset when that's literally the biggest interest rate you can get that is from any major industrial, bond in the world.
Yeah, which is better than nothing.
Well, it's better. You're getting zero out of Europe. You're getting negative out of Japan. You're getting negative out of like 16 of the top 20 countries out there in the world. Yeah, so 1.69, even though it's garbage, it's better than the rest.
So where's the money going is what we're always looking at. Where's the money going? So if it's going out of the stock market as a trader, we need to know that. And where is it going to? Because there's so many ways to trade gold or the bonds,
well,
currencies.
The first area it's going to go is to safety of real estate and safety of utilities and safety of consumer staples. I mean, when we talked about this on the podcast, I want to get you guys' take on it. There's 5 S&P 500 sectors that are categorized as defensive. You have utilities, real estate, healthcare, financial, and consumer staples. My argument, I made this on Monday in the halftime report, and I made it in the podcast as well, is that financial and healthcare are not defensive by nature. And the reason I was talking about it in the podcast at length is I do not want our listeners and our community to think that they can run to a bank for safe just because others consider it a safe haven asset. I mean, on a day when, and just look at it today, guys, on a day when the S&P 500 is now currently down 3%, look at what healthcare is down. Healthcare is down 2.3%. Look at what financials down. Financials down 3.69%. Financials, and this is something I've seen routinely over the course of the last 10 years. When the markets go down, financials get beat up even more than the market does.
Right. Well, you know what's amazing is look at discretionary XLY. It had such a nice run the last year, and this is starting to really. This breaks and triggers. I'm keeping my eye on this one.
Break of one. Keep an eye on discretionary. Break of 114. You should have a lot of good opportunity on the short side.
Because a lot of the discretionary sector is discretionary spending. It's not a safe haven. It's
retail stores.
It's retail. It's your mall. It's your back to school shopping, which I didn't see much lines yesterday.
I think a lot of back to school is going to be at Ross stores and TJ Maxx, not exactly Dillard's and Macy's and Nordstrom.
Dollar store. I just had a picture of my daughter's pencils breaking every 5 minutes.
Let's go to Dollar General to back to school shopping.
Yeah. So that discretionary is a sign of discretionary spending. Financials, banks, energy, oil. What is behind those sectors? What's another one that took a big hit today?
Oh, technology. Every aggressive sector is going to take it on the chin.
Yeah.
I mean, technology down 3.2% today. Basic materials down 2.8%. Communications down 3.4%. Keep an eye on this sector. Is a very important sector, and a lot of stocks that are very popular to trade. If you break 48 in the communication sector, you should see 46 coming into the short term. So there's a lot of opportunity on the bear side here. And that's the thing. Guys, as investors, yeah, we all have investments that are on long term that are taking it on the chin over the course of the last couple of weeks. Everybody does. And we're not going to capitulate and get out of those long-term investments. We're going to attack it like Team Tackle does. We're going to write covered calls against it to offset risk, and we're going to add insurance to those long-term holdings to protect against the volatility. Because you don't buy insurance after your house burns down, or after you die, or after you get in a wreck. We're starting to see the house burn down here, ladies and gentlemen. Get those retirement accounts protected, in my opinion. If the market kind of, stabilizes and you lose a little money on the insurance, so what? You lose insurance on everything you ever spend money on insurance.
Right.
You protect it. You buy insurance to protect against what if. You don't actually want to use your insurance. It's there to protect. And right now we see a lot of risk on type perspective. So write covered calls against those long-term investments, add put options to those long-term investments, reduce the risk exposure. We're not going to get out of long-term investments simply because markets go down. We're going to buy more shares as those stocks go down. But in the short term, this is a great trading environment right now.
Yeah, for movement, it's great. You know what's psychological about it, Matt? I've been there years. I've been 20 years trading. Is when you get the second shoe dropping, and you're one of those people that bought at the bottom, or you're holding on your position. And if you don't have a very big size account, here's what you're thinking. I already know. You're going, darn it, I'm looking at thousands of dollars of loss right now. And you're just a deer in headlights. You're going to try to play the bullish bounce. And when you hear the word insurance, this is just the way it is. I've been to many, many classes. I've met Robert Kiyosaki many, many times. I know how the rich think. You don't have to sell rich people insurance. They either already have it, or they say, how do I buy it? Because they want to protect their lifestyle. It's the middle to lower class, or the people that are swinging for the home runs, that when you say insurance, here's what they hear. You want me to spend more money?
That's exactly what they hear, Gino.
I'm down. I don't want to spend more money. Why am I down? Matt said it's too late to buy insurance, so I'm not going to buy it. So here's the thing, guys. Good news. I got some great news. Cody, if you would, remember last week when I showed people how to buy insurance on the S&P? $5. $5 buys you $500 protection on the S&P. On the SPY, $2. Okay, guys, it's not expensive. It's cheap.
Well, I want people to understand this real quick, guys. Insurance is not a cost. It's an allocation within your portfolio.
It's an investment.
It is. It's an investment. And so let's say you have 100 shares, right? And your risk graph looks like this. Okay. You have all the risk to the downside. You have a ton of gain to the upside. And so when you're absolutely right, when the middle class thinks about insurance, they think about cost, right? When others, the right-hand side of the equation, the B and the I quadrant, when they think about insurance, they think about allocation. Is what they think about. Right. You need to think about insurance as allocation. If the market's going to go down, 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 that's a risky type position here. In fact, a vertical risk graph when you buy a stock is the most risky you can get. It's the highest speculation you can get because you make money as it goes up, you lose money as it goes down. If you simply come out and say, I want to protect just against the short term. I'm not saying protect against the long term. I'm saying I just want to protect this against the short term, and I'm going to go buy 128 days of insurance here. Okay. I'm going to go buy 128 days of insurance. And there's a lot of different ways to buy insurance, but put options are the way to insure against those long-term retirement accounts. And I'm just going to go buy, and we might sell some calls to generate some puts, to generate some cash flow here. Oh, those are so annoying. But when we add that put option, look what happens to the risk graph. And all I did is, I bought a little bit of higher delta than you were showing in the lounge and in the coaches show, Gino. But just by buying one put option, it flatlines the left-hand side of the risk graph here is what it does. Huge. But look at it like this, guys. If the market still goes up past the point of the insurance, you still make money on your long-term account. That's why you should never look at insurance like a cost. It is an allocation in your portfolio that if you lose money on it, fantastic. You still made money as the market went up.
Right. And that's so true. You know, what's funny, Matt, is back to the psychology is for some reason, when people buy a car, they price in the insurance. Oh, I got to buy the insurance. What's my total, right? But when and you know, what's a car? Anywhere from 15 to 50,000, the average car. You know, they price in the insurance because that's just what you do if you want to drive. But their home, what do? I got to buy homeowners insurance. Let's build it into my loan. It's just so I don't have to think about it. Let's build it in my loan. And they get to their financial future retirement account. And they go, I don't know if I want insurance. You know, so it's like, it doesn't make sense. You're going to buy a car that's a depreciating asset.
I'll risk
protect it. But you're not going to protect your financial future, which is also not only your financial future, guys. I'm going to open up a little bit of thinking here and give you some motivation. It's not just your financial future. It's your legacy. It's the future that you leave behind because you're going to leave a portfolio for your family, your kids, your wife, and they're depending on you. So you need that. You're waking up every day to trade their future. That gives you a little motivation, doesn't it?
Well, and that's a great point, Gino.
Insure that thing for them.
Well, especially for those of you who have been in a 401k or within the IRAs and you've been in the investor class for the last 10 years, this is what you have been doing for the last 10 years in those retirement accounts. You're up without contribution. You should be up about 300% over the last 10 years in the S&P 500. And so you've had significant gains in those long-term retirement accounts if you've been doing what you should have been doing as an investor. Well, guys, I think it's okay to give up a little bit of the upside potential to protect everything that you've worked so hard for. And Gino, you're so right there. Think about what you leave behind, not just the cost perspective. Noah, what's your take on all of it? You're still on mute there, Noah.
Unmute myself. Well, I agree with everything you guys have been saying for the most part, and I've been over here greedily trading, trying to secure my children's future.
I saw you, literally. I saw you. Yeah, I know it. No, it's that thing. I'm missing out on opportunity. I'm on the halftime report, and I'm missing out on opportunity. Let Matt and Gino talk about insurance for the next 10 minutes, so I can go put some trades on.
Yeah, I put on about 4 trades while you guys were chit-chatting there.
I will tell you, when I'm analyzing in the halftime report, it is so difficult to get on my other screen and do anything.
Why do you think I had you run the screen today? So,
yeah. Why do you think I was asking you to run the screen today? Me and Noah were arguing earlier today about who should run the screen, and neither one of us wanted to admit that the other one wanted to trade it. Yep. And so basically, I was like, Noah, you host, I'll run, and then Noah runs away, so I have to host and run. Oh,
yep, you're gonna. Well, hey, it's my birthday, so I win.
Is it your birthday today?
It is my birthday.
I knew we were in the zone. Big tackle trading halftime report. Happy birthday to Noah Davidson.
To you. Wow.
Oh yeah, I got to spend it on the round. Yep. Yeah, 39 again this year. It's amazing how that works.
Awesome, my friend.
Yeah. The market went down to have you recover your loss from yesterday solely because it was your birthday today. We should have opened up the analysis with that.
It's got to be. Yeah, because yesterday I was a little grumpy yesterday, but today I'm pretty happy.
Okay. What I would do for the team very quickly, guys, update triggers, update stop losses. Those bear triggers are going to be there. But guys, when we're talking bearish here today, please don't misunderstand something. We're still only on maybe the negative 40-yard marker from an overall perspective, maybe negative 35. So in terms of this, guys, we're talking bear because that's what's happening today. But there's still bullish trades out there to be had. It's a ratio. Remember, you're always delta weight portfolios. You never act like the radical. You have systematic changes. You trade your systems. You update your triggers, and you trade your rules. You don't freak out because of one down day in the marketplace. Can we all agree with that?
Yeah. And Matt, can I just say something real quick? Let me know if you can hear this. Ready? Listen, real quickly. Hang on a sec. You guys hear that?
Yeah, that's Gino trading too. Am I the only one that can't?
That was me taking a little profit on my insurance right there.
I like it, Gino.
Now, bullish trades are down, I'll tell you that. But I just cashed in on my insurance, and it feels good. It feels good to cash that puppy in because I was over-insured. So just so you know, it feels good on days like this.
And when you say that, you cashed in, you scaled out of your insurance.
Oh
is what
yeah,
you did,
I've got a bunch of contracts naked.
Well, I was going to say somebody like a Gino Poor doesn't just buy put options. He's going to do bear credit spreads. He's going to do a lot of different ways to add bearish positions to his portfolio to ensure that. Gino, I want to get your take on crude oil here. Crude oil getting absolutely beat up today, down 5%, down $3 on the day. And I do believe, very similar to the market going down because it's Noah's birthday, crude went down because it hit my trend line. But that's probably not the truth. What's going on in crude oil here today?
Well, let me see here what we got. Oh man, I just lost a chart. Let me see. Okay, there it is. That's a swing high, and that explains the big drop in. And me, I got to put up the dollar. Did you go over the dollar yet?
I've not went over the dollar yet, but let's talk about crude very quickly.
Yeah, that's a swing high trigger right off the channel. And you know what's awesome is I had the exact same channel drawn that Noah does. And I was looking at that. We triggered below yesterday's low. We're downtrending. It's not a strong downtrend. We got a lot of support at 50. Now, most oil traders I know have a line drawn at 50. That's where you got to be careful because that's when the profit margins on oil companies really start to drop. They need it to stay above 50. So we're okay here. Global demand, bad economic global news could hurt oil. And that's what you're seeing today is, and like we just already talked about for a long time, global markets are hurting. And so a lot of times you'll see oil demand drop. So in our commodities report on tackle trading, you can keep up with the commodities all within 10 to 15 minutes of just watching it and understanding what's going on. Just so you guys know, one of my favorite all-time trades is that, what do they call that? What do they call that? Misha, here, Cody, what do they call that stuff, that oil? Texas Gold?
West Texas Sweet Light Crude.
Yeah, I got the
Texas
mug right
Gold,
here.
baby.
I got
Texas Gold.
I got Cody's mug right here.
Exactly what it is.
What do they call it? It's Texas
Texas tea. And hold on. There once was a story about a man named Jed.
Oh, there we go. There we go.
By the way, I just
Black gold.
replay.
Black gold. Black gold.
Black gold. Yeah.
Black gold. Texas tea. Bubbling crude.
The bubble.
Hey guys, everyone out there, if y'all like and want to see how Gino built those $2 and $5 insurance, I just posted a link in the chat, so check it out, guys.
That is awesome.
So, you know, by the way, biggest commodities in the world: gold, oil, gold and oil, silver, and by the way, another black oil, coffee, another big commodity. So, looking at that, there's some great advanced futures trades, commodity trades on oil. Most stock traders trade USO, which is cheap enough to do covered calls on. Great cash flowing product. It really is. It's dirt cheap. It's my go-to when I teach people covered calls because it's so cheap. And it's down at the $12 level and 11 or 12. But, you know, Matt, global demand is what it's all about. Global demand of oil, to wrap it up, is what.
Well, I think you nailed it on its head, global demand. And when we have global economics show recessionary data, oil is going to go down in that environment. People simply travel less.
And my outlook is, just real quick, my outlook is it will go down a lot more because the dollar, if you look at the US dollar when we get to it, it just triggered yesterday.
Yep. Well, and we also had a crude inventory buildup of 3.7 million barrels when we were supposed to see a reduction today as well.
Right.
And so that was big news. Coach Mark, you joined us right in line to talk about crude oil. Mark, what's your take on crude?
I just tweeted on Trading Justice Twitter about oil, and it's a nasty 1-2 punch.
Yeah.
Nasty 1-2 punch. When you have an inventory report that goes bearish and you have all of the macro recessionary global growth concerns, that's a bad 1-2 punch for oil. I mean, I think $50 test of that support zone that's been tested a couple times in the last couple months is very likely.
Well, and I was looking at updating triggers here because I'm not in a position in oil, and I see this little level right here at about 53.5. It's currently at 54.14. I see this level. You got old support over here, cluster of support over here, support right here as well. And so that's kind of where I'm looking at that as a 53.5 trigger. No, what do you think of that trigger there at 53.5?
Well, it's reasonable because it's only eaten up half of the range there, and you still have quite a few points down to 51 support, and then $50, the big number we've been talking about, right? So
Yeah.
I think it's pretty clean. If you take that intraday and you go look at that on like an hourly time frame, you're catching an intraday support zone that's pretty, that's not too bad. You might wait for that to form like an inverted cup and handle or something like that, but
Yeah.
it's a pretty clean trigger at 53.50.
I'm not going to chase it today because I'm not chasing a 5% downward moving already.
Well, yeah, it's
right?
already ATR'd. I mean, when ATR
Oh,
turns
it's
into a verb,
far more than the ATR.
yeah.
I mean,
So the day traders are going to start cashing out here. I would not be surprised if you saw some short intraday rallies here as the bears start cashing in, and
I could definitely see fading at 54.
Yep. So you'll see a little shadow on that maybe, but again, you could probably trade any intraday bear retracement.
I still think the best way to if you're playing crude on the bear side, I still believe the best way is a bear call spread here.
Not a bad idea. Not a bad idea.
At all. And don't forget to look, like I was saying on the commodity report, we also compare BZ, the Brent crude.
Well, and that the great point there, Gino. I was looking at that earlier today. Talk about a perfect trigger here.
Yeah.
I mean,
And,
boom, kiss off the
what's the
20-day moving average there.
What's the difference, Matt? BZ and CL. What's the difference and why
Well,
should
BZ is the international crude, right? It's crude oil as traded out of London.
right?
Crude light is traded out of Chicago. So BZ is heavier to combust. Crude light is lighter to combust, and that's one of the reasons why crude light is cheaper in nature, is because it's simply lighter than BZ, and it typically has a relationship to it. And Mark talked about this on the podcast at some length on Monday.
Yeah,
so if you want to understand the relationship between BZ and crude light, just listen to the pod.
Yeah,
well, most of your Brent crude comes out of the North Sea, like it's Shetland Islands up there in Norway. So you've got a lot of crude light Brent crude coming out of there, and it is slightly different, but.
So I don't trade BZ, but I'll tell you what I do is I put triggers on it in alerts. Right now, let me go see where my alert is. I'm at 56. So if it breaks 56, below that, yeah.
If this breaks 56, crude's already probably
are you on a daily
50, 52, 51, I would say. Last thing I want to talk about before we just kind of open up the conversation is Bitcoin. And can we finally just eliminate Bitcoin as a safe haven asset? Can we finally just say that's not a safe haven asset?
Pretty sure you can.
No.
Anybody that
it is
logically thought
holders think it is all the time.
That's okay. That's speculation.
They've said it's the new gold for the last 2.5 years.
Yep.
Yeah. Anyone who bought it way back when is going to state that simply because they're speculating that it will possibly become safe haven. It hasn't.
Anybody that thinks that's a safe haven asset, I want to play fantasy football with this year.
Well, you got one that you're playing against.
Here is a safe haven asset. Mark, I want to get your take on gold here. Obviously, in times of economic crisis and downward movement in price, gold has a tendency to go up. Mark, you've been all over gold for the last 8-9 months. Okay, I don't know how many times you've said buy. You sound like Jim Cramer sometimes when you're talking about gold. What's your take on gold here? Is it a good trigger, re-entry point? Give me your analysis.
I mean, it is so hard because it's again. I mean, when it was down low, that's when I was pounding the table hard. The fundamentals are all there. It is. Listen, this isn't a pure technical situation. I mean, the fundamentals are great. Everybody knows that. Just absolutely tremendous. And it's just pure technicals right now with gold. You got great fundamentals. You got a strong trend. Every pullback in the last 3 months has been successful. Every breakout in the last 3 months has done very well. So step system, which we're having a webinar on tonight, another webinar on the step system, which Coach Noah is going to be hosting, where he'll be updating some slides for individuals that have not learned about the step system. Gold for the last 2.5 months, step system perfection. Pullbacks, breakouts have been absolutely on fire. So fundamentals are the same great fundamentals that have been for 9 months. Just
and we'll come back. We'll come back to analyzing here in just 1 second, guys. But Noah, the step system is a system for our pro members over there at Tackle Trading, and for the pro members here that's watching, have you guys enjoyed the step system so far? It's a great system. Awesome. I'll let you guys respond in there. But Noah, just quickly speak about what you're going to be covering in tonight's webinar. And obviously, guys, if you're already part of the STEP system, you're a Tackle Team Pro member, you are more than welcome to join us. It will be a review for you, but you are more than welcome to join us. Noah, talk about what you're going to be covering tonight.
Well, one, it's going to be an introduction for new people, people who are considering becoming pro members of Tackle, so they can have access to the STEP system, because I think that's really our flagship system now. And you don't want to miss it, because we're going to be going into the details. Obviously tonight, I think we'll be talking about maybe the bear side of the STEP system and how to use the STEP system in a bear market. There's going to be plenty of opportunities there for you, but it really comes down to a good review. If you're already a Tackle Pro member and you haven't tapped into the STEP system, come out tonight. We'll get you excited about it. If you're not a pro member, we're going to be offering everybody a free trial for tackle trading, so they can check it out, make sure and see if it's a good fit for them. And then we're going to be getting into some of the nuts and bolts, and it'll be a high level overview, but we're going to get some of the nuts and bolts of the bear trade.
And I believe is our first mastermind group next Wednesday.
It is next Wednesday.
Yes,
and yep, absolutely.
And for those of you guys, that first mastermind group we're going to be doing for the STEP system, as the hashtag Team Tackle knows, we always, for every system we have a tackle trade, and we always do a mastermind group once a month for that system. So to be a part of the mastermind group for the STEP system, you have to watch the videos, okay? We don't want to be answering basic questions that the on-demand will cover for you. We want to get in, like you said, Noah, in those mastermind groups, we want to get into the nuts and bolts of how we apply it, the application of it, talking about trade management and when to adjust stop losses and when to scale out. And, because what I've found is sometimes traders will just put the trade on, but then they won't manage the trade, and then they end up taking a loss when they should have managed the trade to take a win. So we're going to get into the management and the decisions we make as traders in trade management after trades are put on. So we're getting into the detail of how you actually trade it. So make sure that you're going through the modules, ladies and gentlemen. And if you're not part of it so far, obviously you can join us tonight with Coach Noah, and he's going to walk you through the basic parameters of the system and how we utilize that in both bull and bear markets. Coming back to the market.
Hey,
here,
Matt, I want to say something real quick if I could.
Yeah.
So as you're saying, you have to complete the STEP system to get in the webinar, because you don't want simple questions being asked, because we want to actually dive into the nuts and bolts. Well, we actually are putting tags on each of your logins. So if you haven't completed the STEP system, you won't even be allowed in the room yet. Technology is fantastic that way. So if you had the thought of, I might just sneak in and not ask a question, no, you have to complete the STEP system to even enter the webinar, because we are putting tags against your emails.
That was awesome. That was Cody's hammer.
That was my hammer.
Big Brother Cody.
My hawkishness saying, "Hey,
get her done."
Not only are we going to impose this, we're going to monitor. That was a very, very not conservative Republican of you, Cody. That was very Big Brother.
No. It was a.
We are monitoring your progress.
Cody, it was a hawkish. Do what you're supposed to if you want the benefits. Is what it was.
That reminds me why I quit college.
Best decision Gino Poor ever made.
Gino showed up and they're like, you're not allowed in. We have tagged your email and tagged your phone. You have not completed anything.
We are the NSA. We know exactly what you're doing at any moment, at any time. But yeah, step up, show up, get it done, right? Last thoughts, guys. I'm going to go down the road, start with Noah, Gino, and Mark. Give me your last thoughts on the market here today. Where do you expect to go? How are you approaching the market from this point on today?
Well, one, I actually put together the newsletter this morning, last minute. So we had a couple thoughts that I put in there. One, reduce position sizes. If you're new to this and this is your first rodeo, reduce position sizes, or sit on the sidelines. Two, shorten your time frame. If you're in there, swing trading's rough. Day trading's awesome. Swing trading's rough. And then for your theta traders out there, stay vigilant, be quicker to hedge or exit rather than let the trade, slowly creep up on you and cause you problems. Your first loss is your best loss.
Like it. And very quickly, Adam, hashtag Big Government Cody. Just make sure to get that on Twitter and tag AOC. It'll make Cody very happy. Gino, your last thoughts here, Gino. How are you approaching the market today?
Wow, I wish I could write as fast as Noah was talking, because that was some great advice, man. That was some really good advice, guys, what Noah just said. Lower your position size or sit on your hands if you're not used to playing the downside. If you are used to playing the downside and you know how fast the market can drop. It's twice as fast, 3 times faster to the downside than it is the upside. Options get expensive because volatility goes up. Definitely use spreads if you know how to use spreads versus long options. There's some great setups in the retail and discretionary area. There's some great things that haven't triggered to the downside. This is the time, Matt, where I break the rules, especially on the downside, where I buy out, way out of the money, put spreads that are cheap, because when the market drops, they get expensive. So I will go out an extra strike or two. When I'm
so sometimes you'll lower your deltas.
Exactly. So when I swing trade, I usually do a 60 delta.
Well, and
I'm using
as an educator, can I just say one thing to that?
Mm-hmm.
I'm perfectly fine with a professional trader with Gino Porter's resume to do whatever he wants to do, right? But for new traders, don't break rules.
Right.
They're there for a reason.
If you're new, sit on your hands and watch the first bear market. If you're brand new and this is your first bear market, watch it. Watch it and paper trade it.
Paper trader. Mark, last thoughts there.
My last thoughts are the same thoughts I've had on the trade war. Anyone that's listened to me on the Traders Lounge, on a nightly show, any of our pro products, on the podcast, the trade war is very unpredictable. It's on the pod. Was it on yesterday?
We recorded 2 days ago, released.
But I was on the halftime show yesterday, and as the market was rallying, I'm like, you cannot trust your eyes. I mean, that is my opinion. That is how I approach this type of market. You've seen this over and over since March of 2018. If you want to go back and read, we have material on our pro membership. It is any given news item, which seemingly is unpredictable, can cause these huge, massive runs, on either side in the market. It becomes very, very difficult for certain trading styles. Now, other trading styles, as you were mentioning, spreads, those credit spreads, those out of the money credit spreads, those have been doing pretty decent.
Well, and also because of the increase in volatility, we can actually go out and sell a 10 delta versus a 20 delta and pick up the same credit on a 10 delta that we could on a 20 delta because of the increase in volatility as well.
I mean, but the trade war is unlike anything I've seen in 12 years because of the unpredictability of the news cycle. It's a crazy environment. Sometimes your eyes deceive you. And I mean, we've just seen that. I mean, if you don't believe me, look at the last 2 weeks.
Yeah.
I know sometimes as old traders, we always get to the point where it's like, I remember when it did this, right? And the news cycle that we're going through right now really reminds me of the European debt crisis of 2011 with the drop when the S&P dropped to 18%. And I remember the Dow Jones was going down 400 points, up 400 points, down 400 points, up 400 points. But it kept its levels of support and resistance. I would focus not on the daily price action, focus on support and resistance.
And we have very clear areas of short-term support and resistance on broad markets.
Yeah, and that's kind of, when you say don't trust your eyes, you're talking about don't trust a one-day price movement in the market.
Yeah, but that's what I'm talking about.
Yeah, but even this one-day price movement in the market yesterday, where'd it come into? Smack dab right at resistance. Resistance hold, trust resistance, trust support. Those things are going to be very important here in the whipsaw, and we should see some whipsaw coming in. It's not just going to go straight down, but I do believe the projections at this point should be to the downside for the rest of the week. So trade with caution is what Coach Noah says. Lower position sizes on the bear side, maybe adjust to more credit spreads, selling deep out of the money options. And if you don't understand how to add insurance to a portfolio or trade bearish conditions, be a part of the bear market survival team over there at Tackle Trading with that premium system, and get excited, guys. Hashtag Team Tackle. Get excited for Coach Noah tonight in the STEP System webinar. And for those of you, I will be in Seattle teaching for the Great Legacy Education this weekend. So if you want to come out and say hello, I will be in Seattle this week, and I will be in Miami next week. Coach Tim will be in Chicago next week. So if you're in Chicago or Miami or Seattle and you want to come out and hang out and say hi and meet the coaches, meet the team out there with Legacy, let us know, and just send us an email, and we'll get you guys the address. Outside of that, you guys have a great rest of the week.
I got 4 things, Matt, real quick. Step System webinar tonight. Iron Condor Mastermind Group for those individuals that have the premium Iron Condor system. That mastermind group is tonight. Matt, Noah, myself, Tackle Trading, all tweeting today. So Tackle Trading or Nor Matt's accounts. I know I will be tweeting a lot today looking for setups.
At Trading Justice. At
tradingjustice.com. And final thing, we had one person drop out of
.com. HTTPS hashtag. Yeah, go ahead.
Okay.
Sorry.
Well, for some reason, Matt really found that enjoyable.
I did. I found the .com funny. I did.
That tickled his bone today.
It made my day so far. I had some great trades today. Had a great trade. That made my day.
And we had one person drop out of our Fantasy Football Trading Justice League. We're giving away a free annual pro membership if you can beat Matt, myself, and Tim, if you can win the Fantasy Football League. So email me at team@tackle-trading. We're drafting this coming Monday night. So email me at team@tackle-trading if you would like to play fantasy football with us and have a chance to win an annual pro membership.
Draft is, I believe, Monday night. We're drafting for
Monday night. We are drafting.
Justice.
I have my entire draft strategy laid out. So
I do not have my draft strategy laid out. I will have a strategy 5 minutes before we start drafting. And I will still win.
Well, we will. That will be yet to be determined.
Yeah. All right, guys. We are out. Have a great rest of your day, halftime crew, and we'll see you tonight in either the Cash Flow Club, not the Cash Flow Club, either the Cash Flow Condors Mastermind Group or Coach Noah with the Step System webinar. And then obviously we have our Traders Lounges throughout the rest of the week. Cash Flow Club tomorrow night, and scatter reports are going to be very important this week, guys. So make sure you get excited for those scatter reports coming out on Saturday. We're out.